The hallways of the Federal Reserve were thick with tension last week as Chair Jerome Powell and his fellow policymakers deliberated behind closed doors. Outside, the financial world held its collective breath, eagerly awaiting any clues about whether the central bank would finally relent in its marathon battle against stubbornly high inflation. When Powell strode to the lectern on Wednesday afternoon, he knew his words carried the weight of the entire U.S. economy on their shoulders. With measured cadence and careful phrasing, the Fed chair outlined a subtle but significant shift in the central bank's stance on interest rates. For over a year now, the Federal Open Market Committee has been laser-focused on slaying the inflation dragon through a series of aggressive interest rate hikes. From the lows of near 0% in early 2022, they have jacked up the benchmark federal funds rate to a lofty range of 5.25 to 5.5%, the highest since 2001, an undeniably muscular response to the alarming spike in consumer prices. But in navigating these uncharted economic waters, Powell and his colleagues now find themselves at a fork in the road. One path points toward further rate increases to definitively stamp out inflation no matter the labor market consequences. The other allows for a cautious pause, an acknowledgement that overly restrictive policy could unnecessarily jeopardize the impressive employment gains of the past years. With a deft linguistic feint, Powell signaled that the Fed is inching toward that latter, more nuanced course. The question will be whether the totality of the data, the evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market, he told the assembled press corps. A green light of sorts for the first rate cut in over a year, possibly as soon as the next meeting in late September. This was no throwaway line. Those carefully chosen words reflected an intentional reframing of the Fed's priorities in a subtle but meaningful way. For the first time in recent memory, the hallowed dual mandate of price stability and maximum employment received equal billing from Powell, a marked departure from the almost dogmatic inflation-fighting zeal that has gripped the central bank since consumer prices began their alarming ascent in 2021. The data helped buttress this policy shift. Inflation, as measured by the Fed's preferred gauge, has been slowing for months, rising just 2.5% over the past year. While still above the 2% target, this is a far cry from the alarming 9% peak of mid-2022 that sent shudders through the economy. More tellingly, Powell cited the significant decline in inflation occurring even as the job market has remained remarkably resilient, with unemployment clocking in at 4.1%, a historically low level. To the Fed chair, this tantalizing divergence of cooling prices and still buoyant employment represented an unusual welcome outcome, an opportunity, perhaps, to dial back the intense monetary policy restrictions without sparking the feared wage price spiral that could send inflation roaring back with a vengeance. The job is not done on inflation, but nonetheless we can afford to begin to dial back the restriction in our policy rate, Powell declared in a statement laden with subtext. While retaining their inflation-fighting bona fides, he and his colleagues appeared ready to rebalance competing economic risks in a more even-handed way. This evolving stance did not go unnoticed in the financial markets. Treasury yields dipped as investors rapidly recalibrated their expectations, fully pricing in an initial quarter-point rate cut next month. Interest rate swaps now envision an aggressive easing cycle totaling almost 70 basis points in reductions by year's end. It would take a major reversal in the inflation data to take September off the table, opined Diane Swank, chief economist at KPMG, a view echoed by former New York Fed President Bill Dudley, who bluntly stated that Wednesday's remarks and statement revisions essentially guaranteed the first cut is on deck, unless the economic outlook changes materially. Yet Powell himself was careful to avoid painting the Fed into a rhetorical corner. In the finest tradition of central bank obfuscation, he left ample wiggle room, allowing that he can imagine a scenario in which there would be everywhere from 0 cuts to several cuts this year depending on how conditions evolve. This calculated ambiguity revealed the tightrope the Federal Reserve must now walk. For all their self-professed confidence that disinflation can proceed smoothly, policymakers remain haunted by the specter of backsliding on inflation after their delayed response to its initial surge. Moving too aggressively to loosen financial conditions risks providing high prices with an unwelcome new lease on life. The worst position for the Fed to be in is backed into a corner, warned Naila Richardson, chief economist at ADP. By preserving maximum optionality, Powell is striving to keep his foot on the monetary policy brakes even as he eyes potential modest easing in the months ahead. There are also political undercurrents undergirding this subtle policy realignment. With presidential and congressional elections looming in 2024, the Fed will face immense pressure should unemployment suddenly spike higher and negate much of the Biden boom labor market gains. Moving proactively to lower rates ahead of such a scenario could provide a much-needed economic cushion, while also insulating the central bank from accusations that it willfully undermined the president's signature achievement. Then there are the more existential considerations for the Federal Reserve as an institution. Having underestimated and played catch-up with soaring inflation, any severe recession or enduring job market carnage from overly restrictive policies would represent a body blow to its credibility with the public. An unforgivable lapse by an unelected body of technocrats tasked with carefully shepherding the world's largest economy. This reputational risk factor surely looms large as Powell ponders his next moves. Having already embarked on one of the most aggressive monetary policy tightening cycles in 4 decades, how aggressively should the Fed ease off the economic brakes? Recalibrate too much too soon, and the hard-won disinflationary progress could rapidly dissipate in a resurgent wage price spiral. Conversely, maintaining an overly restrictive policy stance risks inflicting deeper and more lasting damage on growth and employment. As it mulls this high-stakes balancing act, the Federal Reserve will be closely scrutinizing every new shred of economic data for signs of which path to take at the fork in the road ahead. The labor market's resilience has thus far provided some cushion, but any sudden buckling in employment could force a more dovish pivot. Inflation's trajectory will of course remain the preeminent consideration as Powell and company weigh whether the recent moderation can be sustained, or if renewed price pressures could quickly unravel their hard-fought battles of the past 18 months. In the end, the Fed may find itself grudgingly reverting to the very risk management approach that contributed to its belated response early in the inflation fight. Having relearned the perils of allowing prices to become unmoored, it now faces the unenviable task of nurturing an equally precarious labor market soft landing. A seemingly modest course correction in September may merely presage a more aggressive easing cycle to ensure against over-tightening risks. For all the opaque rhetoric and linguistic precautions deployed by the central bank, the broader message was clear. The single-minded focus on quashing inflation is giving way to a more nuanced, multifaceted framework for weighing economic crosscurrents. A fork in the road beckons for the Powell Fed, and the path it chooses in the months ahead will profoundly shape the trajectory of the U.S. economy for years to come. High-stakes calibrations lie ahead in the hallways of the Eccles building.